Welcome back to an incredibly important episode, and when we look at the market today, we are seeing a lot of red across the board, and you could say it is justified. Market has been continuing to climb to all-time highs, so is worthy of a bit of a slowdown, but one thing we continue to see is healthcare, big pharma companies continuing to crash. We're not just talking a few percentage over a long time. Whilst we see that in just one day, when we look year to date, many companies are up double digit. However, we are now seeing some incredibly poor performances. We have UnitedHealth stand out, down 44%, a huge and important company for the United States. We have Centene Corporation down 54, ELV down 25, as well as many others. And one thing is very, very important to understand today, that even with upcoming volatility anticipated given earnings, the market is sitting in greed/extreme greed, which tells us one thing: investors continue to buy companies at some very high valuations. They're continuing to get stretched. We're seeing that right across the board, and it doesn't matter which valuation metric you look at, even if you do incorporate growth, as we can see here, updated as well. Investors are piling into companies that are already looking incredibly high. We're going to run through some examples because the foundation of the episode today is understanding where retail is currently heading. And we see that the forward P, for example, Broadcom sitting at 39, is well above their historical average of around 18. Doesn't necessarily mean the company should revert back to the average, but this is telling us investors are paying a significant amount of money today for a company that historically traded at such a smaller valuation. That's something we can also see when we look at Broadcom, for example. The blue tunnel here is signaling the expected price. We're seeing massive disparity from where it sits today to the current expected value, and that is something we've seen over the last year for the company. In fact, this overvaluation pretty much dates to the midpoint of 2023, and we can show you many examples right across different sectors, and we will do just to really drill this point home. For example, Oracle 36.4, well above the 5-year average of 18.2. You can see for these examples, the company is also offering you a much lower yield, Oracle being 0.8% compared to the 5-year of 1.5%. And again, the blue tunnel not only signaling severe overvaluation, but it's just showing how much their disparity is, which has been increasing. Investors are just paying some very high valuations. The question is, are these valuations really justified? Because we're seeing the continuation of this trend across other companies like Costco. Yes, we're not disagreeing, these are high quality companies, but we have to understand the price that investors are paying today. 49.3, their average, which does look very high, sits at 39, telling us investors are paying even more today than they would have over the period. Again, confirmation when we can see this is something that has been ongoing over the last year. However, there was quite a period of time where companies like Costco you could have bought at a reasonable valuation, which does signal to us you just need to be patient. Again, another example, we have Walmart trading at 36 above their 5-year of 25, a yield of 1% when historically it's sat at 1.5%. And just to back up all of these claims, we do want to show you the blue tunnel, where again Walmart over the period has been trading severely overvalued. And finally, we'll incorporate the Mag 7 Microsoft 2, great company, but forward P of 35 over the average of 32. Doesn't necessarily mean you should sell the company. It's just in perspective of buying today, you are paying a very large premium in comparison to their historical. And again, this is shown when we take a look here, it is sitting just outside. Now, there were actually periods for Microsoft that you could have bought them below the blue tunnel, what we would say is undervaluation, but we're not seeing this for companies. As we've highlighted, valuations are being stretched. On the flip side, we have a few industries which are being pummeled, giving investors a chance to buy them at attractive valuations. We're going to go through two things today. One, understanding why the healthcare sector, companies like UnitedHealth, have been hit hard, and secondly, our own valuation and what we believe, one, the margin of safety to be, and secondly, our price target. The same thing does apply to big pharma that we'll go through, but UnitedHealth, it is sitting at 13 forward P. The average sits at 20, so that not only is well below the historical, but one of the lowest offered to shareholders, and we can see the yield now well above 3%, when historically it's been much lower at 1.42, telling us investors are selling these companies which are being beaten down for those that are really running at high valuations. Again, UnitedHealth, the opposite of the previous companies, we're seeing disparity between where it sits today and the bottom end of the blue tunnel. And we can also reflect that on ELV, 7.7 on a forward P, the lowest on offer to shareholders in the last 5 years, the average at 14, yield the highest at 2.5% with the average at 1.2. Now we will get to why these companies are being hit hard, but you can clearly see these companies are looking undervalued, and therefore it may be wise to consider companies giving these signals as opposed to others that are looking fairly high. Now we have Cigna as well, 9.5 below the average of 11, yield at 2 above the 5-year at 1.7. And again, the conclusion remains to be seen even on the blue tunnel here. It is even outside the lower end, another undervaluation point. Now this also holds true for companies in big pharma. We have Eli Lilly, which we've incorporated in the episode today because this is one that actually Wall Street and institutions believe is an incredible opportunity. Forward P 30 below the average of 38, and we see the same when we take a look at the blue tunnel. It is sitting outside, although if we were to zoom out over the last 5 years, this is one that for quite some time has been trading severely overvalued. And then we move on to Novo Nordisk. Now this is one that I will perhaps be adding in the short term, sitting at a forward P of 15, well below the average of 30. The yield on offer at 2.5%, given the 5-year sits at 1.4, pretty much giving investors an opportunity to buy this company at its lowest valuation in the last 5 years, the yield at the highest, and the company does look strong overall. And again, for consistency, we will highlight that from the beginning of this year, this one just continues to get more and more undervalued. What's great to note, while share price has been decreasing, the intrinsic value has been moving in the opposite way, which is what we always want to see. And similar to Eli Lilly, this company for a very long stretch of time was trading in severe overvaluation. And then finally, we also want to include Merck & Co., this one with a forward P of below 9, the average at 13, and the yield one of the highest on offer today that we are considering at 4.04% with the 5-year at 3.1. And we can also see the undervaluation signal here, something we've noted pretty much from the end of 2024. Now, Wall Street Journal have actually said that the insurance industry is becoming chronically uninvestable. They throw around some names in the article, notably UNH, Centene, and Humana, all of which we will get to our valuation today. But it's interesting to understand their perspective, and it is for a very good reason too. We also did just hear from ELV, who cut their outlook, where they mentioned higher costs is weighing on the industry. We've seen that as well from the likes of UnitedHealth, who not only cut their guidance initially, but then fully suspended. And if you remember, Centene Corporation suffered a massive drop to their share price, and for similar reasons too. They're noting that healthy Americans are exiting their insurance plans. That means they're left with a lot of older people and those who actually need a lot of treatments, which is affecting the company's bottom line. We then also have the big beautiful bill, which is anticipated to show a lot of cuts in the healthcare industry, but really to wrap this whole piece up in terms of the effects, at least on health insurers like UNH and the others we've covered so far, is that we have costs spiking, people using their health plans, especially in Medicare and Medicaid, getting surgeries or outpatient treatments, which, yes, one hand is great for patients but bad for insurers because it's ultimately eating into their profits. And secondly, we have the government tightening their reimbursement rate for the Medicare Advantage, which is a huge moneymaker for these companies. That means lower payments, high risk, and squeezed margins. As we said, Elevance cut their 2025 forecast, Centene warned on Medicaid, and even UNH are also being cautious. On top of that, we have political pressure ramping up, the big healthcare reform bill in play that could ultimately strip coverage from millions and reduced insurer revenue. So when you put it all together, rising costs, shrinking payouts, and political risk, it's not a surprise these stocks are falling, even if they look cheap on paper. Our responsibility is to understand if they're now too cheap to ignore. We have something similar going on with Big Pharma. We have here Trump vowing to cut US drug prices, which is ultimately send majority of these companies into a bit of a sell-off. We also have Trump wanting Medicare to pay less than foreign countries for their drugs. More tariffs estimated to come in by August the 1st, as we're not really hearing too much now about any tariff deals, which again driving a lot of uncertainty, volatility across the market. And then we have the big beautiful bill, which many analysts are saying there are some ugly new laws that investors of these industries need to be aware of. Now, how exactly does it affect Big Pharma? Well, for their drug pricing, under the Inflation Reduction Act, Medicare can now negotiate prices on top-selling drugs. That's going to hit revenue for some blockbuster medications, and we're also entering a bit of a patent cliff. A bunch of high-revenue drugs are losing exclusivity, and cheaper generics or biosimilars are on the way. We also have pipelines not looking too great. Outside of the GLP-1 craze, a lot of major pharma names are struggling to replace lost revenue with exciting drugs. And if you add in some weak earnings like Pfizer's COVID unwind, Bristol Myers cutting their guidance, the sector starts to look a little bit less reliable. So between price pressure, patent risk, and underwhelming R&D, investors are also hitting pause on Big Pharma. Now, very quickly, we're going to run through 7 stocks that we do believe look to be undervalued. We're talking some ridiculous upside if you listen to Wall Street, but also we see some very nice margin of safety. First one, UNH, getting into it, is down 50% in the last year. Half of their market cap wiped off just like that. Year to date, not much better, down 44%. Over the last 10 years, their performance still, after the drop, not far off the S&P. They're up 140%, trading near their 52-week low. We get, and we will in fact, with every stock today, a double buy from Seeking Alpha and Wall Street. And before we get to our valuation, why not look at what institutions were doing in just the last few months? They had 88% ownership for UNH, selling $37 billion in just the last year. They were buying a lot more at $56 billion. And we also want to flag that in the most recent quarter, they actually sold more than they bought, 1.3 billion sales versus 400 million buying. Now, as we said, we want to get to our intrinsic value for each one of these stocks. UNH updated, coming to just under $400, the average of the 4 models that you do see on screen. Now, we're going through quite a lot of stocks today, and typically we run through each model, the inputs and the outputs. Getting straight to it, just under $400, the price around $281. We always like to use a 10% margin of safety, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode today, a buy at $358, then we keep going till it's near the current trading price, and ultimately we're saying now UNH, lots of issues that we have brought up to consider, is giving a 30% margin of safety around the $279 mark, pretty much where it sits today. Wall Street themselves also bullish. Yes, there are issues. Yes, they have dropped massively. Is the market overreacting? Are we looking like a great opportunity? Wall Street believes so now, 35% upside, $380 price target, and whilst we haven't covered it in today's episode, lots of information we could go through. Members of Congress have also been adding something perhaps to ponder. Stock number 1, UNH, in your own opinion, do you see this as a buy, hold, or avoid? Now, before we get to stock number 2, just to let you know, we have released our latest free weekly article. We draw one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to ELV, which is down around 47% over the last year. Similar to UNH, nearly half of their market cap wiped out in the last 12 months. year to date down 24%, and just in the last 5 days where they did have their earnings, they're down 16%. Now, over the last 10 years, you would have now underperformed the S&P, up only 88%, and they're pretty much trading around their 52-week low, and we get another double buy from Seeking Alpha in Wall Street. Wall Street 4.4, not far off the 4.5 to flip this into the strong buy. And institutions with their 90% ownership sold $10 billion in the last year. They bought around 50% more, and we also see more buying in Q2. 237 million buys versus 87 million sells. Now, our updated intrinsic value gets to $438, but check this out, Wall Street, after all of the noise, their price target actually above our intrinsic value, $450. They see 62% upside, pretty much what we would say is their way of highlighting this company as a screaming buy. Now, margin of safety at 10%, a buy at 394, at 20, 350, and as we keep on going today in terms of the MOS available, not at 40% just yet, you're getting pretty much 35%, looking safer in comparison to UNH purely on the numbers, but there are other things ultimately that one does need to consider. So UNH, we ran through it. ELV, give us your thoughts in comparison to UNH, as well as a buy, hold, or avoid. We then move on to Eli Lilly, and the main reason we've added this in the list today, whilst it doesn't look undervalued in our opinion, it is one that Wall Street do see really highly of in terms of a strong buy. Now, they're down 9% in the last year. Year to date, pretty much flat, but over the last 10 years, up 814%, trading near the 52-week low, double buy from Seeking Alpha as well as Wall Street. And we can see with their 83% ownership, yes, 44 billion sales, but a lot more buying, nearly 3 times as much at 128 billion. And we see a lot of buying, 1.5 billion in the most recent quarter, 310 million selling, but that's a trend we've seen for quite some time from, in fact, these institutions. Q3 pretty similar, but Q2 we do get a significant reversal of the trend. Now, our intrinsic value gets to $692. That is derived from the DCF model. We'll show you, given it is just one model. On average, over the last 10, it's up 44% year on year. We want 35% in line with analyst estimations and to be more conservative, but we have a low, medium, and high, 30, 35, 40. Remember, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, where it is for Eli Lilly or any others. But based on 35% and the discount rate, you get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 691, actually indicating downside of 10%. If you want to be more conservative, and we'll show you for full transparency, 30%, 491, downside of 36. Realistically, if you did want this and you do believe it's undervalued, you'd have to see around 40% growth. That would give you a 958 price target, 24% upside. Now, as always, we want to be conservative at the 35 middle rate, which we typically do. This just highlights we see this as a company trading at a premium. For consistency though, at 10%, we'd say a buy at 622, at 20 around 553, and at 25 around 519. Interestingly, Wall Street, like the others we've covered today and will go on to cover, very bullish, over $1,000 into 2026, 30% upside. And what's interesting, at this $1,000 mark, this is just highlighting to us that Wall Street in fact see their growth rate above 40%, as that would come to 958. Anyway, even using 35%, there is no MOS. Give us your thoughts on this. Buy, hold, or avoid. We then move on to one of my favorite picks out of the bunch, which is Novo Nordisk, down 52% over the last year. One of many, as we've covered, that have lost more than half of their market cap in the 12 months. They've lost one quarter year to date, down 25%. Over the last 10 years, around the similar performance of the S&P, like others trading near the 52-week low, with a double buy from Seeking Alpha and Wall Street. Now, institutions with their 12% ownership sold around $5.5 billion, bought a little bit more at 7.3, but we do see a lot more buying in Q2, 780 million versus 30 million selling. Now, like Eli Lilly, we have used a DCF model getting to $82, and when we take a look, we've used a growth rate of 14%, As you can see, upside of 28, if you use 12%, 13, 16, 45, will actually highlight if you want to be even more conservative at 10%, and that is the average. You can see that is pretty much already baked into the numbers today. So for this to look undervalued, you need to see more than 10%. Now what we'll do, we'll start off with the lower rate at 12% to show you the margin of safety appropriate, and at 10%, that is pretty much where we see this now. Wall Street themselves, again, very bullish, $97 into the next year, upside of 52%. We'll also highlight the rate that we believe most appropriate at 14% to say that you are getting a margin of safety that is fairly respectable, nearly 20%, although at 25 it would be around $62, which could be a great time to consider. At 30%, we're talking around the 52-week low. So right now for Novo Nordisk, 20% margin of safety, 52% upside. Let us know your thoughts. We then have Merck & Co. down 36% in the last year, year to date down 20%, over the last 10 years up 40%, trading near the 52-week low, huge pullback from 52-week high at $129, again double buy from Seeking Alpha and Wall Street. We also see institutions with 76% ownership selling $17 billion, buying nearly twice as much, and in fact in the most recent quarter they've done just that. They bought more than twice than they have in fact sold. Now our intrinsic value, $108, the average of the three. Again, remember you can grab a copy of this model by clicking on the pinned comment below. Will give you a fairly sufficient MOS. At 20%, buy at $87, at 25, around 82. At 30, not quite there yet. So Merck & Co, 25% MOS, just above. Wall Street, very bullish, $104 price target, 30% upside. We then move on to Humana, another one that's down nearly 50% in the last year. Year to date, down 15%. Over the last 10 years, up only 20%. Trading pretty much near the 52-week low, which is almost half of their 52-week high, with another consistent double buy from Seeking Alpha and Wall Street. Now institutions hold 92% ownership, where they've sold $6 billion in the last year, buying 50% more at $9 billion, and buying a lot more at Q2's $30 million versus $8 million sold. And we can see an intrinsic value at $258, maybe one of the smallest margin of safety today, although factor in Eli Lilly was trading at a premium. At 15%, buy at $220. At 20%, not quite there yet. So for Humana, 15% MOS. Wall Street, as bullish as most of the stocks today, $290, 34% upside. Let us know again, buy, hold, or avoid. We then get to Centene Corporation, down 59% in the last year, the worst one that's been battered so far, with year to date down 54%, trading at its new 52-week low today. We're talking a forward P below 10. And when we take a look, another double buy from Seeking Alpha and Wall Street, and we can see institutional ownership 94%, actually selling a little bit more than buying in the last year, but we do also see that continuation of more sells than buys in Q2. And our intrinsic value pretty much staying the same at $73, but this is extremely conservative. Essentially what we have done for the expectation of 2025 is take a look at their first quarter of free cash flows for the year at 1380. We've extrapolated it by 4 to give the full year, then we've cut that in half, and on top of that, to make it even more conservative, we've used negative growth rate of -4%. You can see if you use that or the medium of -2 and in fact the 0%, we're talking over 100% upside. In fact, for those that are very bullish and see this at 0%, meaning no future free cash flow growth, after we've pretty much halved the extrapolated free cash flow, we're talking more than a 3x. Now, clearly, we've highlighted many times we want to be very conservative today. There are lots of issues ongoing with the industry, which is why we're seeing them battered around 50%, nearly each one. But the margin of safety available today, more than 50% at $37, at 60% is pretty much where it sits today. Talking of 60, that is the number that Wall Street see this into 2026. We're talking upside triple digit 114%. Now look, bear in mind there are many issues, some that we haven't even touched upon with the industry overall, but we have covered the majority, which is why we're seeing this industry hit hard, something that seems to be happening every single day. What we're trying to identify on this channel is perhaps where the market is overreacting. We're not necessarily going to find companies that are going to double or triple over the next day, week, or month. We're looking for quality companies that over time will give a very nice performance, outperforming the S&P. If you believe any of these today meet the criteria, then do let us know below. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.